Now the first case study we've got for you, or the only case study today, is Linda and Carl, which appears in our revision guide, and I'm going to share it with you and talk about it. I spent sort of 15 minutes on this one. Now Linda and Carl represent a case study which is pretty traditional, actually, if truth be told. It's one of the traditional ones that the LIBF have in their exams. It has a lot of old stuff like high lending charges and things like that, and reference to investment vehicles for interest-only mortgages. But hey, you've got to understand that kind of stuff because you do have that in the syllabus. So let's get on to Linda and Carl, shall we? And we'll talk about this one. So I got it on here. I'll talk it through with you. Let's just take me off the screen so you can see that in some detail. What have we got here? Well, we've got Linda and Carl have been offered, they've offered $169,950 for their first home. Linda, she's 24, she's employed, which is great. Carl's 26, also employed. So really good couple of first-time buyers there. Now Linda's employer provides full sick pay for 6 months and life cover of twice her salary. Very good. No occupational pension scheme, but she'll have an opt-in one, of course. And other benefits are currently provided. Linda has made no private provision. So she'll have an auto-enroll scheme, but probably very little money. Carl's employer provides full sick pay for 6 months and half pay for a further 6 months. That's pretty standard. He's a member of the company's defined benefit occupational scheme. So that's a very unusual thing, that, isn't it? With a retirement age of 65. He has no other private pension. He currently earns £35,000 per annum. Again, some old stuff here, but you tend to find that in some of the exam questions. Like defined benefit occupational pension schemes haven't been around for donkey's years. Anyway, in addition to the basic salary, he has a profit sharing bonus of $3,000, $3,500 and $3,750 for the last 3 years. Interesting bonus that. It's been going up each year, so the lender may well take half of that into account because, or half of the average or whatever they want to do, because the figures have been going up and doing quite well. So we'll take a look at that one. They want to borrow $154,500. Also at about 90% loan to value, and aware that the lender would require a higher lending charge in excess of 80% loan to value. Again, high lending charges haven't really been charged since the financial crash. They tend to accept the risk and just charge higher interest rates. They're anxious to ensure that they're fully protected, subject to affordability of course. As the house is newly built and guaranteed, they wish to avoid unnecessary expense in this area. So it's brand spanking new, and it's got a 10-year NHBC guarantee. So we don't want too fancy a survey on this property. They would like a mortgage product that would allow them to make capital reductions. So we're looking there at capital and interest, aren't we? Some flexible mortgage. And perhaps be adaptable to fit in with their regular holidays. Not sure what that means. Probably looking at some kind of product where we can make lump sum payments and have holidays built into the monthly schedule. So we're not be looking for sort of a fixed rate which has got penalties and things, isn't it? Neither is a keen investor, preferring to either spend on holidays or reduce their debt to release further borrowing capacity. Well, these guys have got it all switched on, haven't they? They've been informed that their application will result in a credit check, of course it will, and want to know what rights they have regarding the information obtained. So as always, of course, with these case studies, they do give you loads of hints in the case study as to what kind of questions are going to crop up. So as you read it through, remember, make some notes if you can, or at least mental notes, and try and figure out what kind of questions they're going to ask you. So let's go to the first question and see what we got, shall we, on this case study. So here's the first page of the case studies. So I'm going to zoom into the first question. I'll have a quick look at this one for you. When assessing their borrowing capacity, the lender is likely to consider Carl's profit sharing bonuses. Now again, as always, just look at the question first, don't look at the answers. Now Carl has this profit share which creeps up by a couple £100 a year, so it's doing quite well. So it's obviously a regular occurrence. And we've got a number of options here, as you can see. The correct answer is C, an averaged additional income. The others are wrong, you see. Guaranteed regular, no. Additional income only after 5 years, that's just nonsense. And D, completely irrelevant, that's nonsense too. The pure fact is, let's pop in and say hello to you there. The pure fact is that we've got this bonus, and they will take some of it into account, but they'll average it out as an additional income. And they may take all of it, they'll probably take 50% of it. That's how they tend to roll with those sort of things. So that's a nice easy question to start off with, isn't it? Question number 2. Again, this just pop me up there to get out of the way for you. With regards to the information obtained by the lender under the credit check, Linda and Carl can. Again, don't look at the answers. The credit search, of course, Experian, Equifax, whoever, under the data protection GDPR, UK one, of course, now, they have the ability to access all the data to find out where it's come from and what the detail is. So they can contact the credit search agency and get all that information. So we know that, don't we? So what options have we got here? We've got only obtain details with the lender's permission. That's nonsense. Only have access to that held on computer. Well, most data is on computer, but they can actually have paper data as well. Have access only to computerized records on payment of a fee. Well, actually, they can have access to this free of charge if they want to. Have access to any paper or computer-based records held. So the answer to number 2 is D, which is the answer to that one as well. Okay, let's go on to number 3 then. The most appropriate survey and valuation product under Linda and Carl's stated circumstances. Well, go back to the case study. Don't look at the answers. Cover them up, you know. Go back to the case study. They're buying a brand spanking new property straight off the building site. And as a result of that, it'll have a 10-year NHBC guarantee. First couple of years, anything's fixed. The following 8 years, it's insurance-based. There'll be snags to fix, of course there are, but you know, if there's any problems in 10 years, the NHBC insurance side of things will cover it, subsidence and stuff like that. So there's no issue. You don't really need a full-blown survey. So the one that would be appropriate here, and you can see the answer straight away, is A. That one commissioned solely by the lender. That's the basic mortgage valuation. It's commissioned by the lender, paid for by the borrower, and everyone's a winner. But it doesn't do much else apart from value the property, give you an insurance, and have a quick look at the property itself. The other answers there are talking about defects. They're talking about, you know, all major defects are revealed, ensure all major defects are revealed and provide guarantees. They've got with or without guarantees there. Again, the point about the basic valuation is it doesn't give you information about, you know, defects about the property. In major ones it might do, but it won't provide any guarantees. There's no insurance based there. In other words, if the surveyor doesn't point out something, it's you can't sue her for that, because that's not what the report and mortgage valuation is designed to do. You want to buy a bigger survey, a home buyer's report or a full building survey for that one. So that's a nice answer, that one, to question number 3. Question number 4. The survey and valuation product identified in question 3 will cover all of the following except. This used to be quite a common type of question. I call it the domino question. If you got the answer to number 3 right, then you'll get the answer to number 4 right, because it always refers to the answer you had in the previous question. So really what it's saying is that the basic report and mortgage valuation will cover all of the following except. So one of the answers here, it doesn't cover. And the answer here is D, underlying defects in the foundations. It won't. The basic report and mortgage valuation is not designed to survey the property. It's not called a survey, is it? It's designed to give the lender a basic report on the mortgage suitability of that property. The surveyor, she's not going to start drilling a hole into the foundations and checking everything. So D is wrong. A, it'll give you a sketch of the property. B, details of landslip in the surrounding area. It probably will do. C, recommended conditions applicable to the advance. It'll do that too. You know, retentions and undertaking, stuff like that it'll do, but it won't touch the foundations of the property. You need a structural survey for that anyway. A full building survey wouldn't even cover that. So that's the first 4 questions. Nice one. Remember to do them in the right order. Try not to leave any questions out on CeMAP 3. So let's go on to the next question then, which is on the screen. So let's press the button here. Let's get me out of the way then so you can see the question. There you go. As a result of the valuation, so still banging on about the valuation now, aren't they? The lender is least likely to recommend in respect of Linda and Darren's property. Okay, well, I'm not sure what that really means until I see the answers. Is the lender going to recommend a retention, an undertaking, acceptance, or minor repairs? So it's saying which of the following is the lender least likely to recommend? Well, the fact here is that they're going to, well, they might recommend an undertaking. Doubt it. An undertaking is where you promise to do some minor works. They don't check it. A retention there is usually more important works that need doing, like roof repairs. And they retain a couple of £1,000 to make sure you do it. Acceptance would certainly be something that the report mortgage valuation would recommend. They accept the property as suitable security. And minor repairs may be appropriate. They might make a few notes about that, but unlikely with a brand new property. But what they won't do is retention. They're not going to suggest a retention. That's the one that's definitely least likely on a new build property anyway. Older properties possibly. So that's quite a question you've got to get your head round, haven't you, that one? Number 6. Let's move straight on to number 6 then. And I'll put myself over here out of the way. Let's get rid of me for this one. You don't need to do it. The most appropriate mortgage repayment method. Again, use the terms there. Mortgage repayment method. That's the interest only versus capital and interest to meet Linda and Darren's objectives. Well, we know that a capital and interest mortgage is appropriate for them. There was many references about not wanting to be investing or wanting to have security and be able to make lump sum payments and stuff like that. So we know that. But what they've done in this question is they've given you 4 descriptions of a capital and interest mortgage. And you've got to decide which one it is. And if you had a look at them, it's not too difficult to fathom that out. The answer actually is C, but let's take a look at the answer. A attracts tax relief on the monthly payments. Well, the only one that does that would be the pension product. If you took out a personal pension with an interest-only mortgage, that would do that one. B has automatic built-in life cover. Again, the only product or the only vehicle here would have been the endowment, which gave life assurance built in, and that of course would have been for an interest-only mortgage. C automatically reduces the interest payable. I like that one, don't you? D provides a potential tax-free surplus. Well, that one is designed for, again, endowment mortgages or possibly a pension-linked mortgage. So C is the right answer because the capital and interest mortgage, if interest rates stay the same, your monthly payment stays the same. But as you start the mortgage off, you're paying much more interest than you are capital to begin with. Large amounts of interest, small amounts of capital. But as the time goes on, you pay more and more capital and less interest, because that's how it works. So C, therefore, is the right answer. Automatically reduces the interest payable. Nice one. Okay. Number 7. And I can pop back in here for this one. Oh, there we are. Let's just shove down there for a second. The mortgage product that fits Linda and Carl's stated criteria could offer any of the following. Now, again, don't look at the answers. What mortgage product were they looking for? Well, they were looking kind of for the ability to repay. Let's have a quick look at the case study again, because this is really important. So let's just put this back up for you. And we'll flick on to the next part, which has got the details about the mortgage product here. Here we go. Yeah. So last paragraph there. They would like a mortgage product that would allow them to make capital reductions and perhaps be adaptable to fit in with their regular holidays. Neither is a keen investor, so that puts off the interest-only mortgage, preferring to either spend on holidays or reduce their debt. That's what they like to do, don't they, with their money? Credit check. So they'd like a mortgage product that would allow them to make capital reductions and perhaps be adaptable to fit in with their regular holidays. Now, the mortgage product, of course, is your fix, variable, cap, that sort of thing. And what we're looking at here is a product where they can make capital reductions. So we don't want any restrictions on making lump sum payments, do we? We don't want any of that, because that would not be good. Let's just say hello to you there. They also want a product where they can have maybe payment holidays. These have not been around for a while now. They're flexible mortgages, they used to call them, where you can make any payment you like, really. There's usually minimums per month. And because of that, you can overpay, you see, in some months, and then maybe have 1 month off, like a Christmas or holiday. And you can make lump sum payments anytime you want to. Now, all mortgages pretty much allow that feature nowadays, but they used to have a product which literally promoted that idea. So that's where we're going with this one, which is quite interesting, isn't it? So if we then go back to question number 7 then, and take a look at that one, which we've just been looking at for you there as well. Okay, let's pop down here, get off for a second. So the mortgage product that fits Linda and Carl's stated criteria could offer any of the following except, again, 3 of these things are right and 1 is wrong. Now the answer is D, an equity-linked savings plan to fund regular overpayments. Now that's just a load of nonsense, really. I mean, an equity-linked savings plan would be some kind of ISA, wouldn't it, to fund regular overpayments. I don't know where they dug that out on, but it doesn't provide that anyway. The other three it does: a genuinely lower interest rate for the initial period. So we're talking about a discounted mortgage, aren't we? And the discounted mortgages often came with flexible payment abilities. A lump sum in excess of the mortgage amount. Yeah, you can make lump sum payments. The facility to miss payments on a regular basis. Yeah, maybe at Christmas you could miss a payment, or for their summer holidays to be able to up your spending money. So 7's an interesting question, isn't it? D is obviously the wrong answer, but you can certainly get there by eliminating the first 3. All good stuff, isn't it? Number 8 for you. The product which would most provide comprehensive coverage for long-term sickness for the main earner. Now we're talking about the life assurance and the income protection now, aren't we? Which is something that we want with this customer. Now this product provides long-term sickness for the main earner. We're talking about income protection, aren't we? Income protection insurance, income protection plan, permanent health insurance, call it what you like. This is the product which pays you pay the premium each month, like forever, until you retire. And if you're ill and can't work because of illness or disability or accident, then it will pay a percentage of your pre-disability income until you go back to work or you retire. So that's what we're looking at here. So the product which would provide the most comprehensive coverage should, and now it's giving you a number of options. The correct answer here is B, have a 52-week deferred period. Because if you can remember, they both had sick pay from work, and they had different categories of sick pay, didn't they? But just to remind you what they were, just flick back over here. Let's take me out there. Third paragraph there. Carl's employer provides full sick pay for 6 months and half pay for a further 6 months. So he would want a 12-month deferred period for his income protection. Definitely. Now Linda is paid full pay for 6 months, and then she gets none by the sound of it. So they both get good pay from work. Good companies they work for, don't they? But for him, he would want to have a 52-week deferred period. So let's just put that back up for you. He would want to have a 52-week deferred period. Now the other answers, of course, are wrong. So the product wouldn't provide A, unemployment cover, because that's accident, sickness and unemployment. C, a sum insured of at least 154,500. That's life assurance. And D, or critical illness, D, be specifically linked to the monthly loan payments. Again, that's accident, sickness and unemployment, ASU, or mortgage payment protection, whichever one you want to look at. So the only real answer there is B, and that refers to income protection. So again, they're not being specific, they're just making you think about the product and one of the features built into it. Interesting question, that one, isn't it? Okay, let's go on to the last couple of questions then. So we're comfortable with that, so let's zoom in there for you. Now, 9. If affordability of the product identified in question 8, remember what did you identify? Income protection. If the affordability appears to be an issue, Linda and Carl could consider. Now what can they consider? Now, the thing about income protection plan over the last few years is it costs a bit of money each month. I mean, I've carried income protection for 30 odd years, and right now my premium is over £200 a month. It's not cheap, but it provides a lot of benefits. But they have tweaked it in the last few years, and we have what's called the short-term income protection. You might have heard of that. Now typically, if we just illustrate this over on this whiteboard for you, let's get the whiteboard going. Typically an income protection plan, IPP, provides cover until you retire. So you know there's your time scale, and there's your retirement date. So you could be retiring at 65 or whatever. I'm retiring at 70 odd, which is where mine takes me to. And you make your premiums, and if you claim at any time, it'll then make monthly payments to you until you get better or retire or die, whichever comes first. And that's why it's called permanent health, PHI. It used to be known as permanent health insurance. It's permanent, can't be cancelled. But to make the policy cheaper, in other words, to reduce the cost, they brought in this short-term version. And what a short-term policy does, quite simply, is gives you a specific term. So the customer might be age 30 when they start it, and it might stop at age 35. In other words, it's a 5-year term. That's one option which the marketplace is allowing. That's not good cover, of course it's not, but it's better than nothing. Of course it isn't. And some of them make it so that it pays out for a short term. So you might have cover for all of your life, but when it pays out, it may only pay out for a couple of years, or maybe 6 months, depending on the illness. These short-term policies are relatively new, and they basically bring the premium down. So if we go back to our case study then, number 9 there. So if affordability is an issue, the alternative product is C, alternative cover for a shorter payment period. The others, of course, refer to different issues. Shortening the deferred period would just make it more expensive. Excluding unemployment cover, well, IPP doesn't include that anyway, does it? D, an alternative product covering a specified list of illnesses. They're talking there about critical illness policy. So you see what they're trying to do? They're trying to mix you around the different types of protection. So you do need to know your stuff for this exam, so don't underestimate it at all. Let's go to the last question for you. Number 10. Let's pop one in there as well, shall we? Let's move me over here. Now, the sum insured required under the higher lending charge based on their offer price. Okay, we've got a very old-fashioned higher lending charge or indemnity guarantee calculation going on here, and it's giving us the sum assured. So that's the value of the policy that's going to be taken out. Of course, these things haven't happened for like 12, 13 years, but they may come back one day. The government provide them under their scheme, and the lenders pay the government. Anyway, let's work out the numbers, shall we, for you? So we're going to head over to the big whiteboard, because we can. There we go. Let's pop across here for you for a second so we can just work out the numbers for you. Again, bit of an overview for you on higher lending charges. Now, what I would always do with a higher lending charge is I would always draw in my picture. So there's my property. That's what the client wants. And I always draw my vertical line, because you need to put some numbers in this. First of all, you need the value of the property or the purchase price, whichever is the lower figure. And for this one, we're talking about a purchase price of £169,950. Now, hopefully it's valued at the same figure. If it's valued less, that's the figure you take. The next thing you want to do is to take a look at what's the basic advance. Now, the basic advance, if I just put the slides back up quickly for you, and we'll put that one over here, number 4. At the top there, they wish to borrow £154,500 and are aware that the lender would require a high lending charge in excess of 80% loan to value. So that's the key information, isn't it, really? Isn't it? So 80% loan to value, which I've already worked out, and I'll put it over here for you, 80%. That's the key. That comes in at 154. No, 135, get that right. 960. So that's the amount of loan that the lender would normally lend without charging a higher lending charge, which is why lending below 75% is a lower interest rate, because nowadays lenders just increase the rate to pay for this, don't they? But back in the day, they charged the same interest rate for whatever your own loan to value was, but they charge a high lending charge, but only above 80%. Now, the guys are looking to borrow 154, let's put that in there for you, £154,500. That's their advance. That's their mortgage that they're looking for. It's about 91% loan to value, I think. Now, the higher lending charge is based between the two. So anything above that to the loan they're looking for, that's the amount of the higher lending charge. And, well, you could just do your maths, couldn't you? That comes in at 18,000. It's a big one, this. 540. That's the difference between the two figures. And that would then be applied by a percentage. For this one, it's probably going to be about 6%, I would have thought. That's how they would used to do it. And that would then work out a premium, which would then be paid by the borrower to the lender. The lender would use that money and pay the insurance company. That's how it used to work. And the insurance company, of course, would then set up the policy, provide the policy in the name of the lender. So if these guys defaulted and didn't make payments on their mortgage, the lender could then, and they sold the house under possession and they were a shortfall, the lender could claim that money, that shortfall, subject to a maximum of 18,000 policy from the insurance company, less 20% excess. And that would then cause subrogation. But we've got other videos on that topic in more detail for you. So that's one. So just whiz back to the case study very quickly so we can see where that one, if we just head over to the question, which is here. And as you can see, the answer there is B. It's quite clearly there for you, isn't it? So interesting case study, that one. Some old stuff in there, high lending charges, income protection plans, life insurance coming in as well. So quite a lot of aspects of the mortgage methods, products, decisions the customer has to make. So I hope that's been useful. Bye.